Today we're doing a complete breakdown of AASB 112. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before AASB 112, understanding tax liabilities was like peering into a fog. With this standard, companies now clearly report deferred tax liabilities and assets, impacting decisions by showing true tax expenses. Imagine a $10 million deferred tax liability, now visible on the balance sheet. By the end, you'll grasp how AASB 112 clarifies this complex area. AASB 112 exists to bring clarity to tax reporting, solving the inconsistency that plagued financial statements. By enforcing transparent reporting of deferred tax liabilities and assets, it enhances comparability across companies. This standard helps stakeholders understand how tax expense relates to accounting profit, aligning tax reporting with the financial position. Imagine knowing exactly how a $5 million tax liability affects profit. AASB 112 makes that possible. Entities preparing financial statements under AASB must comply with AASB 112, effective since January 1, 2005. The crux of this standard is recognizing deferred tax assets and liabilities for all temporary differences. This requirement ensures that companies accurately reconcile tax expense with accounting profit, providing stakeholders with clarity. Consider a financial analyst examining a $2 million deferred asset. AASB 112 mandates this visibility, ensuring informed decisions. The deferred tax accounting model simplifies understanding tax impacts on financial statements by recognizing tax effects of temporary differences. These differences often stem from timing discrepancies, like revenue recognition, affecting income and expenses. This model is vital for predicting future tax liabilities, crucial for cash management and planning. In interviews, explaining how it clarifies a $3 million tax assets impact demonstrates your grasp of financial nuance. Scope clarifies what lies within a standard's realm, especially in AASB 112. Candidates often forget that taxes based on income from foreign operations aren't covered by this standard. A classic interview trap. Knowing precisely what's included and excluded can make or break your understanding in a high-stakes setting. AASB 112 applies to income taxes payable, receivable, and deferred tax assets and liabilities. It focuses on tax effects of temporary differences. These areas impact financial statements by aligning tax obligations with accounting records, ensuring accuracy and compliance. Understanding these inclusions helps in preparing accurate tax-related financial reports. AASB 112 explicitly excludes taxes based on income from foreign operations, VAT, and other sales taxes. This focuses the standard on income-related taxes, simplifying compliance. Understanding these exclusions helps avoid errors in reporting, especially in complex multinational operations. Tricky interview questions often explore these boundaries, testing your detailed knowledge of the standard. A temporary difference arises when the carrying amount of an asset or liability in the balance sheet differs from its tax base. For example, if equipment is depreciated over 5 years for accounting, but over 3 years for tax, this creates a temporary difference. Such differences result in deferred tax assets and liabilities, affecting future tax calculations. A deferred tax asset represents a future tax benefit due to deductible temporary differences. For example, if a company has warranty expenses deductible for tax before being recognized in financial statements, this creates a deferred tax asset. It anticipates a reduction in future taxable income, offsetting these temporary differences and impacting future financial health. Navigating AASB 112 scope involves understanding edge cases. VAT on imports, foreign tax losses, local property taxes, and offshore subsidiary profits all present unique challenges. Each falls outside the standard scope for different reasons, such as transactional nature or foreign jurisdiction complexities. Grasping these nuances is key to mastering what's included and excluded, especially in an interview setting. Imagine a company needing to report future tax consequences accurately. The deferred tax accounting model addresses this by identifying temporary differences. Ensuring these are recorded correctly prevents financial misstatements, aiding businesses in aligning their tax reporting with actual financial realities. Deferred tax accounting is vital for reflecting the tax effects of temporary differences. Using Meridian Corporation's $10 million SaaS contract with Acme Incorporated, we'll explore how each step ensures their financial statements reflect true tax positions. This journey simplifies tracking and adjusting tax impacts over time. Meridian Corporation's contract with Acme Incorporated reveals a key difference. The $8 million software license is capitalized, affecting taxable income differently than its financial reporting. Recognizing these differences is essential to calculate deferred taxes accurately. A missed temporary difference often leads to skewed deferred tax assets or liabilities, compromising the financial transparency of the company. Building on Meridian Corporation's $8 million temporary difference, we apply the 30% tax rate expected at reversal. Misjudging this rate leads to incorrect deferred tax calculations, impacting both current and future tax expense recognition. Correctly applying the statutory rate ensures accurate reflection of deferred tax liabilities or assets in financial statements. With Meridian Corporation's temporary difference in tax rate, the deferred tax liability is $2.4 million. Missteps in calculation often cause mismatches in tax accounts, distorting financial insights. AASB's framework ensures that each deferred tax asset or liability aligns with the company's genuine tax commitments, maintaining financial statement integrity. Meridian Corporation's $2.4 million deferred tax liability now appears on the balance sheet, aligning financial reporting with tax realities. Failure in proper recognition distorts financial health perceptions. AASB's standards ensure the visibility of deferred tax positions, aiding stakeholders in understanding potential future tax cash flows and their timing. Meridian Corporation must reassess its $2.4 million deferred tax liability with any tax rate changes. Neglecting this review results in outdated and potentially misleading financial reports. AASB's guidelines ensure that companies consistently update deferred tax positions, reflecting any regulatory shifts, thus keeping financial stakeholders well informed about the entity's true tax position. The measurement method you choose directly impacts your balance sheet. Picking the wrong method can overstate assets by millions, skewing financial ratios and misleading stakeholders. AASB 112 sets strict guidelines on measurement and mandatory disclosures, ensuring that investors get a clear picture of a company's tax positions. Understand these rules to navigate financial reporting effectively. When first recognizing deferred tax assets and liabilities, finance teams must use the tax rates anticipated at reversal. This means considering future tax changes and ensuring that recognition only occurs when there's more than a 50% chance of utilizing the asset. For example, a company expecting $200,000 in future taxable profit must ensure this condition is met at the reporting date. Ongoing measurement of deferred tax assets and liabilities under AASB 112 requires using up-to-date tax rates. This means revisiting these figures at each reporting period. If tax laws change, remeasurement is necessary, directly impacting profit or loss. For example, if a tax rate change affects a $500,000 asset, the remeasurement could significantly alter reported net income. Always review carrying amounts to ensure accuracy. How you present deferred taxes can change financial perceptions. AASB 112 requires separate balance sheet entries for deferred tax assets and liabilities, unless offset conditions are met. This ensures clarity. Income tax expenses, including adjustments, appear in the profit and loss. Disclosure notes further explain significant items, offering stakeholders a deeper insight into potential future impacts on cash flow and shareholder value. AASB 112 mandates disclosures that reveal the company's real tax position. Reconciliation of accounting profit and tax expense sheds light on tax strategies. Explaining tax law changes gives context to deferred tax adjustments. Disclosing unused tax losses highlights potential savings, while noting unrecognized tax assets alerts analysts to future opportunities. Together, these disclosures create a full picture of tax-related financial health. Imagine a CFO discovering a $1 million deferred tax liability due to a tax rate hike from 25% to 30%. This change requires remeasurement, impacting net income, and necessitating strategic financial adjustments. Accurate reporting becomes crucial, as does communicating the implications to stakeholders. This real-world scenario underscores the importance of proactively monitoring tax rates and maintaining agile financial strategies to manage unanticipated impacts effectively. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. This journey through AASB 112 will reveal the nuances of deferred tax accounting. See how Meridian navigates taxable temporary differences across its operations. The recognition of the lease liability and corresponding right-of-use asset is guided by AASB 16, impacting the balance sheet. Meridian's commitment to pay for the lease is now transparent, ensuring a true reflection of its financial obligations. This entry aligns with the principle of matching expenses with the periods they benefit. AASB 112 requires recognition of deferred tax liabilities for temporary differences arising from lease accounting. Meridian estimates a $90,000 future tax obligation. This entry anticipates deferred tax costs linked to the asset's depreciation, differing from tax deductions, ensuring accurate future tax expense projections. Each lease payment decreases the lease liability, reflecting Meridian's ongoing commitment. AASB 16 mandates these payments directly reduce the liability. This ensures the financial statements accurately portray Meridian's decreasing debt over time, while the asset continues to provide operational benefits. Depreciating the right-of-use asset systematically reflects its consumption. AASB 16 emphasizes aligning depreciation with the asset's benefit period. For Meridian, this $20,000 monthly charge reduces profit, offering a realistic view of asset utility and financial performance over time. Year-end deferred tax adjustments ensure accuracy in future tax obligations. Meridian's $10,000 reduction reflects revised estimates of tax-deductible depreciation. AASB 112 ensures these liabilities mirror real taxable impacts, refining future tax expense forecasts and enhancing financial statement reliability. Settling the lease liability concludes Meridian's financial obligation for the warehouse. The $1,080,000 payment closes the loop on the lease. AASB 16 guides the recognition and derecognition processes, ensuring the balance sheet accurately reflects all resolved commitments. Derecognizing the right-of-use asset reflects its full consumption over the lease term. AASB 16 mandates this removal once the asset is fully depreciated. This step finalizes the asset's life in Meridian's books, ensuring a clean slate for future transactions. Finalizing deferred tax adjustments ensures all taxable differences from the lease are reconciled. Meridian's $80,000 adjustment aligns tax liabilities with actual asset usage. AASB 112 emphasizes these closures maintain accuracy in reported tax expenses, enhancing financial statement transparency. Every Big Four and investment bank interview on AASB 112 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A deferred tax liability represents taxes owed in the future due to taxable temporary differences. These arise when taxable income is less than accounting income. Commonly, depreciation differences create this liability. Understanding this helps manage tax planning and avoid surprises. Remember, it's about timing, not permanent tax avoidance. Deferred tax assets arise when there are deductible temporary differences. They represent future tax savings. These occur when accounting income is less than taxable income. Loss carryforwards are a common example. The key takeaway is that deferred tax assets reflect potential future tax benefits companies anticipate. When an asset is revalued, deferred tax is calculated on the revaluation surplus. This is because the asset's carrying amount exceeds the tax base. The surplus is recognized in OCI, not profit or loss. A common mistake is neglecting OCI, skewing financial statements. Always consider the tax implications of revaluation. Indian Accounting Standard 12 aligns closely with IAS 12, but differences exist in recognition criteria and measurement. Indian accounting standard may require entity-specific judgment for uncertain tax positions. A key takeaway is understanding the nuances and local adaptations of global standards to ensure compliance and accurate reporting. Adjust deferred tax balances to reflect enacted or substantively enacted rates expected during reversal. Use the new rate to calculate both deferred tax assets and liabilities. Always update your calculations to avoid misstatements. Remember, accuracy in tax rate application affects financial comparability and transparency. AASB 112 applies to income taxes, including current and deferred tax. It excludes other taxes like VAT or GST. A common trap is misclassifying tax liabilities that don't fall under income taxes. Understanding this scope ensures accurate application and compliance with the standard. Recognition requires probable future taxable profits to utilize the asset. This involves assessing future income projections and tax planning strategies. Lack of evidence leads to non-recognition. Misjudging probability can distort financials, so always back your assumptions with robust forecasts. Disclosures include components of tax expense, reconciliation of effective tax rates, and deferred tax nature. Transparency in these areas aids investors' understanding. A common oversight is incomplete reconciliations, impairing insights into tax positions. Detail is critical, as disclosures impact perceived financial health. If future profits are uncertain or insufficiently evidenced, recognition isn't justified. Overestimating profit leads to unwarranted asset recognition. This trap requires cautious forecasting and conservative assumptions. The essence is corroborating projections with realistic, achievable targets to ensure sound accounting. AASB 112 sets the foundation for handling income taxes and financials, ensuring clarity and comparability. It covers taxable profits and deferred taxes, focusing on temporary differences. Current tax is immediate, while deferred tax accounts for future periods. Understanding these basics helps in maintaining effective tax reporting. The deferred tax accounting model under AASB 112 employs a balance sheet approach, capturing tax impacts of temporary differences. Measurement relies on applicable tax rates. Recognizing deferred tax liabilities is mandatory, while assets hinge on probable recovery. This nuanced model underpins precise tax accounting. For interviews, grasping AASB 112's intricacies is vital. Recognize tax traps and distinguish it from similar standards. Precise disclosure of tax components and rates is mandatory. Judgments on asset recoverability and reconciling tax with profit are key. Awareness of future tax changes ensures readiness for accurate financial reporting. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.